Hey, it's Chappies Crypto here with my Futures 101 series. This is episode 3. This episode is going to be talking about risk management. Let's get straight into it. This first slide is really just talking about the two different types of contracts that I've been focusing on. It's really just the difference between the E-mini and the E-mini micro. And the key theme being, and this really goes into risk management because it really has got a lot to do with position size. So depending on the size of your account will really depend on the type of contract you'll be able to trade. So it's good to have an understanding of this. It's really in regards to the value or the point value or the size of the contracts. And as you start to trade, you'll get an understanding fairly quickly if your account is big enough to handle E-minis or you need to look at micro contracts. One of the things you need to start to think about if you're going to start to trade is how big of a position you can take on any one trade. So with futures trading, it's very different to equities or other types of trading in the fact that you're in and out generally if you want to look at intraday trading or if you want to look at short-term trading, because ultimately when you take a position, you're risking that amount of money on that particular position. So for me, this little table is just a really good way to summarize it. So as an example, if I've got a $5,000 account and I decided that each trade I'm willing to risk 2% of that account, that means I'm willing to lose $100 on that particular trade. What does that mean in regards to how many trades I can take or how bad of a streak I could have? Well, ultimately, if I lost 50 trades in a row, my account would be gone. And that's 50 losers in a row at $100 per size or per trade. That means that $5,000 account would be obliterated. So for you've got to make your own decisions around this. A lot of people that recommend people when they get started trading risk no more than 1% of their trading account. And if you've got a trading account of $5,000 as an example, your position size is only going to be $50. So that's the maximum you're willing to risk on any one trade. That allows you to trade up to 100 trades in a row of just all losers before you lose your account entirely. The key thing with risk management is protecting your capital. If you don't have capital, you don't have a business or you don't have a trading career. And if you think about running your own business, it's like stock. So your capital or your account balance is actually your capital, or this is your stock of trade. So without that, you're dead in the water. And what I'm finding that if you're trading, say, a $10,000 account balance and you're only really looking at 1 or 2% risk on any one position, it's just not a big enough position to trade anything but the micro contracts. If you were at say a $25,000 account and you were doing 2% risk, you might actually be able to take E-mini contracts. But for me, at a $10,000 account size, I'm just not finding with the type of trading I'm doing, I can take anything more than a couple of micro contracts in each position because that's the maximum I'm willing to lose per trade roughly. And it allows me to trade, and if I lost 50 in a row, I'd still have an account balance. But what does that actually mean? What does position size actually mean? Well, when you're going to place a trade in the futures market, and this is just a screenshot from Tradeovate when you bring up to place a trade, it's the same concept if you're a trader on any other platform. However, the nice thing I really like about the Tradeovate trading calculator essentially, so this is the screen that comes up before you place your trade, is it allows you to put in some information. So this is the actual price. So this is if I'm going to do a buy order, which is the same as a long. This is telling me this is the price that I'm looking to place the order at, and it's a limit order. I'm saying I'm going to place 2 contracts, and by default what it's saying is that 2 contracts are going to be risking $88. So that's what I'm risking at that price. And if I go to do the reason to do it because I automatically tick stop loss. So if I say give me a stop loss automatically, stop loss is calculating based on where I've positioned my stop loss is 12,000. That's the price level I've positioned my stop loss at. So if you can imagine, this is the current price here, and I've identified this area down here as an area that I want to set my stop loss. And a stop loss is an order that will be automatically placed when I place this order. So if I've ticked that, it allows me to control my risk. And this is what I talk about when I mean position size. So based on where I'm setting my stop loss, will TradingView calculator will automatically telling me how much I'm risking. So once again, if I've got my order placed at this level and my stop loss is placed down here, the distance between those two is the size of my position, if that makes sense. So I'm taking 2 contracts out and I'm risking $88 based on where I've set my stop loss. And so that makes sense if you were going to be trading and only wanting to risk up to $100. That, you know, it would make sense in this particular scenario that you'd risk or you'd take on 2 contracts. Now, if you're going to risk 2% of your starting capital and you're trading with the $10,000 account, you can have a slightly bigger position. And once again, same scenario. So if this is the order that I want to execute at that price, that's the stop loss I've identified on my charts. That's how much I'm willing to risk. So based on that scenario, if I just type in 4 here, it'll automatically calculate the amount of capital that I'm risking there. It's a really cool feature with TradingView that allows you to do that. So hopefully that makes sense, but the key thing is that's the price we're executing at. That's the price that my stop loss is automatically set to. So hopefully that makes sense. The key thing here is just understanding position size. Position size for me is based on how much you're willing to risk. So if I'm willing to risk a maximum of $100 on those particular price levels, that informs me, I'm looking no more than $100 to be the figure there. So that tells me I literally just type in 1, it'll say 44. If you type in 2, it'll say 88. If I type in 3, it'll go over $100. And so I know then for me, I'm going to stay under 3 if I'm doing $100 maximum risk. But just understand that when you do this on TradingView, this figure is set by wherever your cursor is when you right click it, and this figure here, I'm just typing this manually into the calculator, or you can actually type the figure in here as well. It's easy to if you watch some of my trading journals, I actually show you some examples of how I do that live. So the other thing that's really important, in my opinion, to understand is this concept of what's called a risk to reward ratio. So risk to reward ratio is really talking about how much money or how much you're going to put here, how much you're willing to risk, and how much, what's the reward going to be based on how much you're going to risk. So if you can imagine here, if I'm risking a ratio of 1, then the payback will be 3 on this example. What does that actually mean? Well, how many trades am I able to take, or what's my break-even rate? What can my break-even rate be before I'm either in front or behind? So if you were working on a trading system where that gave you a 1 to 3 risk to reward ratio, or you're doing a trading style where you're trading to 1 to 3, you're looking for trades that give you 1 to 3 risk to reward ratio, you would have to break even at least more than 25% of the time to make sure you're in front. In other words, out of every 4 trades, you can lose 3 of them. As long as you're winning 1, you'll effectively stay break even, as long as you're getting that risk to reward ratio in your trades. So what does that mean in practice? Well, here's an example. So as an example, if we start with a trading balance or an account balance of $10,000, so this is the goal that I've got, and I take my first loss. So I'm going to work with an example where we're working to a 1 to 3 risk to reward ratio. In other words, that's how much I'm willing to lose, and that's what I'm hoping to win on each trade. So I've got an account balance of $10,000 and I'm working on a 2% position size. So the very first trade I took is a loser, and I lose, so I've lost $200. That's my first. My running balance is $9,800. So my second trade is another loser, and we go down another $200. I'm down to $9,600. And my third trade here, we got another loser. So we had 3 losses in a row. I'm getting very frustrated right now. If you can imagine the feeling of this, my account balance is down to $99,400. And then my fourth trade's a winner. So nice thing with this risk to reward ratio, we're going to win $300 or $600 in this context or this example. Our account balance is back to 10,000, and then we go back to the losing streak. So as I work through this example, you'll see every 3 trades, and I've just done this as a rough example. So I can take 3 trades, take 1 winner, and I'm back to the account balance, which is a break-even percentage rate of 25%. So this example just shows you over 20 trades, if I've only actually won 5 out of 20 trades, I'm still at break-even. So that means I can actually really stuff up my account and take 75% losses here, and I'm still going to be break even if I'm looking for trades that gives me this risk to reward ratio. In other words, my winners have to give me this reward of $600. If that was only giving me $400, then my break even rate will be different. But what happens if we use the same concept, still working for a 1 to 3, but this time we've actually won 7 out of 20 trades. So rather than a break-even rate of 25%, what happens if we win 7 trades? Well, look at the difference here, massive difference. So the only difference being is that this time we've won 7 trades out of the 20. Account balance there is 11,600. So based on the different types of trading systems you might want to work with, you'll start to realize fairly quickly that win rate is actually important, but it comes in combination with the risk to reward ratio. So it's not always important to always get lots of winners, because if your risk to reward ratio is a really high risk to reward ratio, you can actually come out quite substantially in front. And I'll give you another example. What happens if you've got a risk to reward ratio 1 to 5? What happens then? Well, let's have a look. So we've got, work our way through this one. So this time, as you can see, we've got a win rate here is 1,000. So each time we win here, we're still losing 200 because that's the position size we decided to trade with. Is 2% of my $10,000 account balance. But when we hit a winner, we're actually winning 1,000 because we're going to 1 to 5 risk to reward ratio. So every winner is 1,000. So I'm not going to win as frequently probably, but depending on my trading system. About this one, on this example here, we've only got, and we've gone back to that 25% win rate. So we've only got on this is an example. So there's 1 winner, 2 winners, 3, 4, 5. So I wonder, the question is, can I find a system that gives me a 25% win rate, and then can I find trade setups that gives me a 1 to 5 risk to reward ratio? Because if I can, I'm gonna make $2,000 profit on a $10,000 account over 20 trades. So it sounds really simplistic, and the challenge as you start to learn how to trade is that, in my opinion, this is more important than anything else, understanding these concepts of managing risk. I've listened to lots of traders that have been trading very profitably for a very long time, and a lot of them actually talk about the fact that they're not actually traders, they're actually risk managers, and they understand how to minimize the risk and maximize the reward. So in this example, once again, we're only looking for a 25% win rate. So I wonder if it's possible to find a trading system that's going to give us that sort of win rate, or that'll give us, that's not a very good trading system in the fact that we're only at a 25% win rate. However, if I can find those 5 to 1 risk to reward trades, then we're going to make some money here, or we're going to be in a profitable position. Here's just an example of how the risk to reward ratio and position sizing works in TradingView. So here's an example of a trade set up from the last trading session I was looking at. It's not a trade I actually took. I actually took the trade, but I got stopped out too early, and I'll just show you what that actually means in a bit of detail. So if you're familiar with the ICT trading system, this is a particular type of trading style that I'm learning at the moment. And in this example here, I've got a couple of things drawn on the chart. This is a Fibonacci retracement tool. I've just marked out this as sell side liquidity. Prices come up above that, taking out the sell side. We've got a big fair value gap here. Excuse me, been waiting for a break in market structure, which actually happens here. Got a fair value gap there. So for me, this is the area I'd look to take a short position. So when I'm trying to work out my position size, what I mean by position size is if I'm going to place my trade here and I've decided I want to place my stop there, I need to work out how many contracts I can take if that's how big my stop loss is going to be. And also if I've got this as a target. So if that's my target profit level, that's where I think price might draw to. Remembering that usually when you're placing your trades, you don't see what over this, you're not normally seeing this area, obviously. So in an ideal scenario, I'm placing my order here. I'm going to place a short order there. That's where I've identified as an area I'd like to take a trade. My stop is up in this area. So how do I work out my position size? Well, first and foremost, the cool thing about TradingView, and I'll actually show you this tool, it's a really awesome tool, is this one here, short or long position. So if you're going to do short, you choose a short position tool. If you're going to do long, it's a long position tool. So in this context, we're using short position. Come and place it where I'd like my short placed order to be. And you use this tool to work out your position size ultimately. So if I drag this down here and I set it at where my stop loss needs to be, and I drag this down here, or you're firstly working out if this is a good trade, you drag this down here to identify where your target is going to be, which is just down on that level there. You'll notice here, it tells you your risk to reward ratio, which is awesome. So this tells me that this meets my criteria if I'm working on a system where we're trying to get 1 to 3 risk to reward ratio. Because when I look at that, you go, is that a valid setup? Knowing that you're obviously not seeing this side, the stuff to the side here. However, if you think this is a realistic trade, you might want to take that position, and you would actually then need to work out, well, how many contracts can I put on if that's the size of my stop loss? So how do I work out the size of my stop loss? Using the same tool, if you put your cursor over top of this tool, you'll see at the top there, it tells you the size of or how many points it is from there to there. So this first number where it says stop is 53.25. That tells me there's 53.25 points is the size of my stop. And similarly down the bottom, it says my target is 161.75 points. So what does that actually mean in dollar value? So remember, you just need to know the value or the size of each point, or the value per point if you're trading one contract. So let's get it a full screen for a second, because I've got a little screenshot in the background here, which will help us work out which one of those slides. So this is the contract we're trading at the moment, and as we know from previous lessons, the value per point is $2. So the value per point is $2. All we need to do is do a quick calculation. If we're trading one contract and the value per point is $2, so 53.25 times 2 is 53.25. I've just got a calculator off the side of the screen. 53.25 times 2 means that one contract is worth $106.05, or $106.50. So if we've got a $100 limit on our risk reward, you basically couldn't take a stop that big. However, if you wanted to squeeze a little bit out of it, you could probably take one contract. If you're going to trade a risk ratio or position size of about 2% of your account, you probably could take 2 contracts on that. So if I'm taking 2 contracts, I'm just going to times that amount by 2. So I'm risking $213 on that trade, and for a potential reward of, it's 161.75 points times 2, and that's $323 profit if I could take one contract. If I take 2 contracts, that's $647. And so that's just the simplest way, or the quickest way possibly, to work out the amount you're actually risking there. If you're trading live markets, that actually happens quite dynamically through the trading calculator. However, the details are up here as well. So hopefully that's really helpful. The other number that's just to the right of that percentage is the number of ticks. That's 213 ticks for your stop loss, and down here at 647 ticks for your take profit. There you go. So that's just a quick example within the Trading View chart on how to work out your risk to reward ratio, as well as a quick simple way to work out your position size. 2 takeaways from me, and this is one of the things I'm really picking up from. I'm just very much a beginner in regards to being a profitable trader. I'm definitely not consistent yet in regards to my winnings. I'm still trading a demo account. I've been trading for about 18 months. I've traded money for probably the first 12 to 15 months of my trading. I'll be honest, I went backwards during that period. Not a huge amount of loss, but I definitely wasn't consistently, and I ended up with a bit of a small loss after that period. Taking the last probably 3 to 4 months off now, with just totally focused on learning how to trade more effectively. And these are the 2 points I've gotten to in regards to risk management that I've really picked up on from listening to heaps of interviews with heaps of traders. I've read the Market Wizards book by Jack Schwager, and one of the things I'm just consistently hearing is you need to pay attention to understand your win rate. You don't need to have a trading system that's 75% effective or 25% effective. You just need to understand what your win rate actually is. And once you've got a good understanding of that, you need to do this last part. And this is one of the things I think is a difference between highly successful and profitable traders and the ones that aren't, is you need to learn how to cut our losses quickly and let our profits run to improve that risk to reward ratio. So to get a 1 to 5 risk to reward ratio, you've really got to have faith in your positions you're taking. You've got to have a pretty tight stop loss so you can get a setup that's going to give you that really substantial risk to reward ratio. So that's my little summary of the risk management in the context of futures trading. That I suppose the concept goes across to any type of trading in cryptocurrencies or equities or anything like that. But the key message I take away is these last 2 points: is look to cut your losers quick and let your profits run to improve risk to reward ratio. And you need to have a really good understanding of what your win rate is so you can actually choose an effective risk to reward ratio to work on. Hope you enjoyed that one. Look forward to producing some more 101 series futures trading videos. I'm going to spend some time over the next few ones looking at a few different topics, such as the type of brokers that are available to trade on, and a few other things that I'm really learning and I'm enjoying the journey. So hopefully you're enjoying it as well. Until next time, it's Chappies Crypto. Bye for now.